Hello, my name is Robert Killins. I'm an associate professor of finance with the Wall College of Business at Coastal Carolina University. And this is a Wall College Wire. And the purpose of the Wall College Wire is to provide some perspective and discussion around current business and economic items in and around COVID-19. And today I'm going to go over a short video titled COVID-19 in Your Financial Portfolio, at least what's left. So let's jump in and see what kind of impact COVID-19 has had on the financial markets, and particularly the equity markets in the United States. So here's a chart to kind of give you some context around COVID-19. Many of you are already aware of the rapid increases in cases per day, especially in the U.S. over the last 3 or 4 weeks. So that's the chart you see on the left. Those are daily cases beginning about in the middle of January to March 29th. And the snapshot you see on the right is that, almost 1/3 of the world's population is under a full or partial lockdown. And you can see that the various different countries and the timeline they have implemented their full or partial lockdown. And this has brought economies almost to a complete halt. And because of that, the prospective cash flows for many companies have also dried up, and those forecasts have impacted equity markets and the stocks of many companies very significantly. So if we look at a chart, this is called the VIX Index. Okay, this measures implied volatility for investors, and many times referred to as the fear gauge or the fear index. And you can see here from this chart goes all the way back to 1990. We haven't been at levels of the VIX Index since the 2007 to 2009 financial crisis, and many prudent and well-known portfolio managers will consider this to be persistent through most of the next 2 or 3 months. So we're going to probably stay at levels of the VIX north of 50 for some times, probably 2 or 3 months. But this slide shows you, hey, there's a lot of uncertainty in the market, and this is going to last for some time. So let's look at the equity markets and the performance of these equity markets over the last month, year to date, 6 months, 12 months. There's been no place to hide. So you can see here on the left-hand side, these are all different indices of major U.S. price indexes for equities, whether it's the Dow Jones, the NASDAQ, the S&P. They're all been hammered in and around the 20 to 25% range year to date for most of those large major indices that track U.S. Equity markets. On the right-hand side, this just shows you the sectors, and there's really been no sector to hide. I guess the only three sectors that have performed relatively better than most are the consumer staples, healthcare, and actually the IT sector. But major sectors that have gotten hit, the energy sector, there's kind of been a double shock to them, not only a demand shock, but a supply shock. They're down over 50% year to date. So you can see those numbers there. No place to hide in the equity market. So, we're officially in a bear market now. This slide shows you that this has been an unprecedented collapse into a bear market. This shows you the S&P 500 bear markets and the numbers of days it took to fall into a bear market. And you can see here on the top, it only took us 22 days to get into bear market territory in this collapse here. And this is by far faster than any other bear market that we've seen since 1946. Put that in perspective, in the 2007-2009 financial crisis, took us almost 274 days to fall into a bear market. So this has been sharp, fast, and we're still not sure how long this bear market's going to last. But give you some context of potentially how long the bear market could last. This is the bear markets and bull markets. Hey, bear markets will always give way to bull markets, so we have hope ahead. When is that going to happen? Who knows? But we know that the average bull market lasts for about five years, and the average bear market lasts for about 1 year. Okay, and so during those bear markets that last approximately a year, we typically see a cumulative price decline of about 33%. So we still have a little ways to go to get to the 33%, depending upon what index you look at. But hey, if a bear market lasts 1 year, who knows, we might be in this for a little bit longer here. Many people think we'll be in a V-shaped recovery. Time will tell here, but this gives you a little bit of historical context of bulls and bear markets. So final takeaways and suggestions. Okay, news comes in so fast, it's hard to forecast what's going to happen later this afternoon as opposed to next week or next month. So very difficult right now for economists and financial economists to kind of take this data in and make some sort of rational model out of it. Panic's not an investment strategy. Okay, you know, if you don't have the risk appetite for these huge swings in the market, defensive capital preservation on the equity side is probably a prudent suggestion for you. Don't try to pick a bottom at this point in time. Timing the market has never really been a good suggestion at any point in time, whether we're in a bear market or in a bull market. COVID-19 confirms at the end of the day that asset allocation is very important for you, and your asset allocation should correspond to your risk tolerance. So you should have a nice mix of equities, bonds, and non-risky assets to offset some losses potentially that you would see in a bear market from your equity position. Another point here, there's never been a good suggestion here of when you can get into the market. I mean, we saw some very overvalued equities in the last 2 or 3 years. This kind of underscores the importance of, hey, getting in at a reasonable price is a very good thing to consider. That's going to have a huge impact on how you calculate your return if you can get in at a good price. And many people weren't able to get in at a good price in the last couple of years, and they're going to be hit quite substantially here. And no matter how volatile the markets are going to be in the weeks or months ahead, use some discipline, use some patience, disengage from your emotions, and you'll be able to find some good investment opportunities. So that's it for this Wall College Wire. My name again is Robert Killins, Associate Professor of Finance at Coastal Carolina University. If you want to reach out to me, there's my email address. Have a good day, and thanks for watching.